Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 39. Interesting little thing called the dollar cost averaging. Don't get scared by the terminology. Not too bad a thing to understand. There's our disclaimer. It's all about facts. It's about information. It's got nothing to do with advice. So, question there in the bold print: when's the best time to invest? The best time to invest is regularly. So we're not talking about investing on February or investing on your birthday or something like that, even though that's regular. What we're talking about here is putting money in on a reasonably regular basis, be it weekly, fortnightly, monthly, so to speak. And the advantage of putting money in regularly is we don't have to concern ourselves as much with what the market's doing. Now, a couple of weeks ago, we showed a chart of the American market there sort of going up through the stratosphere, and it all looked a bit precarious. And people saying, well, if that's the situation, I'm not really going to start in my investing regime when it's at that level. And you can certainly understand why. And also comes down to the situation that if I had $100,000 or something to invest, I possibly just wouldn't put $100,000 in one go, especially with what is going on with interest rates and so forth at the moment. But putting money in on a regular basis, the idea is here, if we're putting in smaller amounts, at some point in time here, we are putting money in right at the right time. You know, the market has fallen, we start putting some money in, and we get the advantage as the market goes up, we're making money on that contribution. Now, other times we're going to get it completely wrong. We put some money in when the market has just got towards a peak, and so the market then falls and you lose some of the money that you just put in. Now, of course, it would be lovely if we had this, crystal ball that will tell us when the market's going up and when the market's going down and so forth if we start investing into the market, because literally then we could just time ourselves so that we just make sure we put it in at the right time and not the wrong time. But if we're putting money in regularly, sometimes it's going to be the right time, sometimes it's going to be the wrong time, sometimes it's just going to be that Goldilocks sort of halfway between sort of thing. So it just comes down to a situation, what we're doing here, by putting it in regularly, we're sort of ironing out the peaks and the troughs, the ups and the downs and so forth of what the market is going to do. Now, of course, if we're going to put our money in dribs and drabs, and you've got to understand, of course, that there's more transactions going on here. And if you to buy shares, then yep, every time you buy, there's a brokerage cost. There's a cost in actually buying the shares. And of course, that can add up if you're starting to just put in very, very small amounts of money. So our dollar cost averaging, you've got to weigh up the difference between what it's costing you to spread the money out, compared to the risk and so forth involved. And of course, again, we'll never know the right answer until later on when we've got information as to what did happen. You see a thing there called buy-sell spreads, and we will go into this later on. But at the moment, just understand that every time you buy and sell, there's a little bit of difference between the price you buy it at and the price you sell it at. There's a gap between these two prices, and every time you buy and sell, you're losing out towards those two different prices. Anyway, we'll go through that, but just have it in the back of your mind that, yep, every time we do a transaction, if we're looking to buy into the share market, be it funds or be it shares or whatever, there will be some costs, generally speaking, of getting in and getting out. So if we put our money in one hit, yes, it will still pay a brokerage, but because it's one big lump, the brokerage may be less compared to doing 10 smaller lots and so forth. To get an idea of this, what we're talking about here, let's have a look at a little picture here. And here's a chart of the NASDAQ, which is literally all the top technology stocks in America. So it's all the companies like your Netflix and AI companies and all sorts of things that are well known as being a technology type stock. And we've got this little chart. Little green bars there means that on that particular day the market was going up, and red bars mean that that day the market actually went down. And so you don't have to worry about that. What we can see here is on the left-hand side of the screen, when we're talking about there October, I'm not even sure, yes, 2019 this was. Back in October of 2019, if you can see the graph, the price of buying the NASDAQ at that particular time was about $7,600. Now it went up and up and up into February of 2020, and the price of the NASDAQ got up to just nearly up to $10,000. And then we basically had COVID, and down with the market in one awful jump, down, plummeted, back down to below where it was from the beginning of this chart. Only to see that countries and so forth stimulated, put money out there to try and stop the slide because of COVID, and the markets loved all this free money and low interest rates, and up she went again. And by the time you get through to June of 2020, then basically the market was already higher than where it was in February. So we've got a bit of a sawtooth there as the market went up, fell quickly, and then rebounded reasonably quickly as well. Now, so if we'd put our money in, let's imagine we got $100,000. That'd be nice just to sort of invest somewhere. And we put our money in, even if it was only $10,000 or $5,000, it doesn't matter the amount. Just the fact that if we put it in, say in early February, we might have had a little bit of a rise into sort of middle of February, only to see COVID hit and the money that we put in gets severely knocked about because the market then falls down into the middle of March. But so within a month, this thing has lost quite a percentage drop, and we'd be probably, dare I say, pretty upset. And we might even think, especially if this was our first foray into investing, might say, well, this is not for me. Pull your money out a month later and never come back to it. If, however, you didn't really know what was going on, but someone said you should invest, so you got your money ready and you're organised, and you got in and started investing your money into the middle of March instead, and all you had was this market go up from there, you would think, gosh, this investing thing's a piece of cake. I've got this under control. You should have done this earlier. And you might even add more money because of the money that you were making as this thing, as its value went back up again. So you can see it can certainly affect your psyche if you're getting in at the top of the market and it falls compared to getting in at the bottom of a market as it goes back up. But as I say, we don't know in advance. We printed off this chart here in June of 2020. We could look backwards at what the market did, but we certainly don't know what it's going to go forward. Now, so I've just drawn those sort of lines on there to look at what the market was doing, just that trend upwards in those two sections there. And but look at the little blue arrows. The blue arrows is basically showing you the first day of the month when the markets are open. So these are working days. And on the first day of the month, then we are assuming we're going to add some money. So we add money at the beginning of November, beginning of December, beginning of January, February, March, April, May, June. And if we had our 100,000, you might be putting in, 10,000 every month. If we've got 10,000, we might be putting in $1,000 a month and so forth. So we're just spreading our available money, and we're going to put it in, within this period of time here. If you then look at it, you say, well, okay, in those first 4 months, the price was going up, but I did buy it, a little bit above 8,000 and 8,400 and 8,800 and a bit about 9,200. So you were the price was getting more expensive. So the first one you've done very well on. The last one you haven't made as much money on because it's only gone up a little bit since then. But in theory, you're in front. Now, of course, then COVID hit, and basically down she went. And we even added some money there into March, even though the market had fallen. We added in March and we bought that at around about 8,900 or so, but only to see it disappear, a big chunk of it in percentage wise, as the market fell in towards middle of March. We didn't give up, we didn't panic, and we just literally just kept on adding our money on the first of each month there. And of course, yep, we got some we bought at the beginning of April, and when the market was only 7,600, so we bought quite cheaply in April, only to see the next 2 months go back up again. And so by the time we bought again, put some money in June, we're actually this is the most expensive that we've ever done. But if you add it up over the year, so we've got 1, 2, 3, 4, 5, 6, 7, 8 different contributions there. So over 8 months, we've put our money in on a regular basis. So if we add up all of those different prices and then divide it by 8, we actually get the average price. What did it actually cost us for all of that as an average? Sometimes it was expensive, sometimes it was cheap. What did it cost us? And the average price was about 8,700. And so you can see you sort of bought a little bit above, perhaps halfway, but you did buy well, below the top, a little bit above and above the bottom as well, but we did buy at an average price. And so you look at that and you go, well, actually, considering what that market did by roaring up and falling, collapsing, and then roaring back again, I didn't do too badly. It's like I got in a little bit late, but I certainly wasn't completely stupid by getting in, putting it all in at the top. So you can certainly see that this can spread the risk of markets quickly falling just after we've put the money in. Now, of course, some people could say that there's an opportunity loss here, that had we put all of our money in, back there in November, it was $8,000 or so that you purchased it, so that's even cheaper, But did we know that? Of course not. But they're also saying that if you put the money in and over 8 months worth of growth, even the Dow did go up and down, longer term. But is 8 months really a long term in the investment world? Not really. 3, 4, 5, 6, 10 years is a long term. But to get your money in within 8 months is not a long term at all. In which case we've taken the advantage of a reasonably short time frame, but spread our risk here. Now, obviously, this example is a little bit of an exaggeration where we had such a nasty fall there into March. But to get the same idea, no matter what the chart would look like, sometimes we're putting in high, sometimes we're putting in low. We get in at an average price. And that, for some people, can literally be a much more comforting feel, especially if they did have a loss in the very early days. They have only got a small amount of money that's been invested. So a small loss on that amount probably wouldn't then scare them out of continuing to put more money in. Anyway, so investing can be a lot to do with psychology as well. So, how do you feel? We don't want to scare you off. And so if anything we can find that can sort of iron out those extremes can quite often be quite beneficial. And we hope you join me again on another session.